Hi, everyone. Welcome to our third segment on imperfect competition. And in this segment, we're just going to elaborate a bit on monopolistic competition, that industry structure, and then do a few comparisons to perfect competition regarding excess capacity, blocking entry, and then a general appraisal of monopolistic competition observations. So let's look at the, the long run situation in a perfectly competitive firm. Perfectly competitive industry faces perfectly elastic demand curve, and it's perfectly elastic. So it's horizontal right there, right at the current going price that's determined in the industry. So that's how we start looking at the old perfect competitive solution. And this is a picture of the individual firm. So perfectly elastic demand, and we just find it in the long run when they determine where marginal revenue equals marginal cost. Excuse me, if there was any profits, those profits would be eroded because there's freedom of entry and other firms would come in. So that in the long run, the profit maximizing quantity, where marginal revenue right here equals marginal cost right here, is this red dot. There's the quantity. But you notice at this price, this is also equal to the average cost. So they're producing at the lowest average cost, and that is at economic capacity. Remember, the definition of economic capacity was production at the lowest average total cost. And this solution shows that in the perfectly competitive industry, in the long run, that's where they end up. So we want to contrast that to the monopolistically competitive industry. Remember, in the long run, they still have a downward sloping demand curve, right, for that little bit of market share they have. And therefore, they also have a downward sloping marginal revenue curve, right? So in the long run, if there was profits, in this case, firms come into the industry stealing some of their market share, and their demand curve continues to shift left or go smaller. It reduces until it just touches this average cost curve at a tangent. And that's where, well, marginal revenue equals marginal cost right here. You can prove it for yourself. There's marginal cost, marginal revenue. The quantity that the monopolistically competitive firm will produce is right there, QMC. And the price they charge is right up here, slightly higher than the perfectly competitive solution, PMC. But we want to show here that in this case, because the competitive firm faces just an elastic curve, when we do the marginal revenue equals marginal cost, they end up producing at QMC, which is less than the quantity that perfect competition would choose to produce at. So monopolistic competition ends up producing below economic capacity compared to perfect competition, which ends up producing at economic capacity. So here's the monopolistically competitive's quantity right here, but perfect competition's is way up here. So that difference from there to there is the amount of excess capacity, the amount of capacity that's left before they reach the point of economic capacity, which is the lowest of the average total cost. Okay, so comparing perfect competition to monopolistic competition will produce below economic capacity. And notice that monopoly does too, if you want to go back and have a look. And it's because monopoly also has a downward sloping demand curve. If you were in a monopolistically competitive industry and you were somehow able to block entry of other firms. Remember, we said there was ease of entry and exit, but if you were somehow able to block entry and exit of other firms, or specifically entry of other firms to compete against you, then maybe you could maintain your positive economic profits in the long run. So that's indeed what some monopolistically competitive industries and firms try to do. Well, one way of preventing entry is create a professional association like the Engineers Association or the Association of Geophysicists or the CEA accounting, the CPA accounting association, and just give the perception out there, advertise that only your members are competent. So someone that's a good bookkeeper can't do your books because you need a competent CPA accountant to do it. So they restrict entry into the CPA through difficult exams and only letting certain numbers in, for example, so they can allow themselves to charge more, maintain positive economic profits. You could also have government policy out there that's doing the same thing. Example, licensing of governments to allow taxis to run. You can't just go out and start a taxi business. So that creates a small barrier to entry and lets you have maybe a little bit of economic profit. The government also imposes quotas on things like, chicken production, cheese production, milk production. So that quota, in a sense, is blocking new competitors from entering that. And therefore, they can charge higher for those products and maintain some of those economic profits in the long run, not just in the short run. The last example we want to look at and maybe explore a little bit is franchising. If you can create a franchise, or if you own a franchise, you basically buy the right to exclusivity. You buy the right to be the only franchise, the only McDonald's, for example, in a certain area. Now, other non-franchise competitors can come into that area, but you're the only franchised competitor that allows in that area. So in essence, you're acting a little bit like a monopoly. So if you own a franchise, then you get some fairly competitive advantages that allow you to keep some of those longer run economic profits. And the first one is you gain large scale advertising, right? So you can block out other products competing with you because you're benefiting of the large scale advertising that, say, McDonald's does. And bulk purchasing too. You get advantage of getting bulk cups or bulk burger bags and things like that, just because the main company purchases in bulk, and they pass those savings on to you as well. And of course, let's not forget about branding. I often feel sad when I drive through small towns and I see some of the big franchises there. And what it does is, because they have such strong brands, it squeezes out the local town products that might otherwise be able to compete successfully. But when a big franchise comes in, it can squeeze that out just through their own successful branding. So you know probably how this works, but in simple terms, each franchise member, they pay a franchise fee, and these can be millions of dollars. And then they basically guarantee that exclusive territory, their exclusive geographical territory, their region, their several block radius in a busy city, where they're guaranteed that that franchise isn't going to be allowed to set up another arm. So only other large-scale franchises can compete in their areas. So you'll see a McDonald's and then a Burger King or an A&W nearby, but no more McDonald's are allowed into that area. So that does limit the entry of competitors to a certain extent. And the whole idea of doing this, again, of course, is to allow those franchise owners to earn economic profits in the long run. So we said we were going to compare monopolistic competition to perfect competition. And in some senses, it's the same thing as comparing monopoly to perfect competition. And the results are similar because monopoly and monopolistic competition both have a downward sloping demand curve, and perfect competition has a horizontal sloping demand curve in long run equilibrium. So let's look at these points specifically, and we'll be able to click back a slide or two to emphasize them graphically. And first of all, we say point number one, that monopolistic competition produces a lower output than perfectly competitive firm. And I'll say in brackets, well, monopoly produces a lower output than perfectly competitive firm too. But let's click back a few slides and see this in the picture. So right here, we see that the perfect competition solution is right here in the long run. That's the quantity that's being produced. But the monopolistic competition quantity being produced is back here. We already said that means there's excess capacity, or the monopolistically competitive firm will produce below economic capacity. Okay, so let's go back to our points. The second point is it does not achieve long or productive efficiency. So what that means is in the long run, the price doesn't equal the minimum of the average total cost. So that's our productive efficiency point, is that price would be, or we'd be producing at minimum average total cost. And in the long run, that's not the case for monopolistic competition. So we'll go there and have a look. And if I come back here, yep, here's the quantity that we're producing in monopolistic competition. And we'll see if we go all the way up to the average cost curve, it's right there. That average cost is above the minimum average cost, which is over here. So monopolistic competition produces at a higher than minimum average cost, so it does not achieve productive efficiency. That long run price does not touch at the minimum average total cost. Okay, so let's take a look at the third point. Monopolistic competition charges a higher price than perfectly competitive firm. Okay, let's go back and take a look and see if that's true. Well, here's our price for monopolistic competition in the long run. It's up there. And here's our price for perfect competition in the long run. It's down here. So yeah, monopolistic competitive firms charge a higher price in the long run than perfect competition. But remember, so did monopoly. They've got the same type of demand curve. It's downward sloping. We'll come back and look at the fourth point. It does not achieve allocative efficiency. Monopolistic does not achieve allocative efficiency. And allocative efficiency is where price equals marginal cost. That's the perfect competitive long-run solution. So let's take a look at our graph here and see if that's true. Here's where price equals marginal cost in the long run for perfect competition, perfect. But for monopolistic competition, at their optimal quantity here, notice that marginal cost is right here. There's its curve, and I keep going up the graph till I hit price. Well, in monopolistic competition, price right here is quite a bit higher than the marginal cost is at the optimal output. So price does not equal marginal cost in the long run solution. So it does not achieve allocative efficiency. And that's the same thing for monopoly. Now, two things I want to say. All of these conclusions are the same for monopoly when compared to perfect competition, just more extreme. And for monopolistic competition, these are the conclusions, of course, just less extreme differences. And the 4 points are a little bit difficult to pick out because they're all on one slide. That's why I'm clicking back to show those graphs so you can see exactly that they're all true observations when comparing monopolistic competition or monopoly to perfect competition. So let's do this quick example. If we're saying this firm is monopolistically competitive, that means it's got this downward sloping demand curve and downward sloping marginal revenue curve. And if that's the case, what output will it produce? Well, we know always it's the same old, same old. We go to the point where marginal cost equals marginal revenue, and that's right there. And I look down, and that's the quantity we want to produce. It's the profit maximizing quantity. Okay, well then it's saying how much excess capacity exists at this level. Well, we have to remember that excess capacity economic capacity is the output at the minimum average cost. So there's the minimum average cost, and there's my output. So the excess capacity is the amount that Q2 is different than Q4. So that's my excess capacity right there. Monopolistic competition is producing Q2. Capacity output is Q4. The difference, Q4 minus Q2, will be the excess capacity. Let's take a look at their answers and see. Yep, produce where MR equals MC. We got that to get Q2 right here. How much excess capacity exists? Yep, Q4 minus Q2 is the excess capacity that exists. So that's it for this segment. We just elaborated a bit on monopolistic competition. We looked at the long run solution compared to perfect competition. We did that appraisal of monopolistic competition versus perfect competition, and then talked a bit about blocking entry, so we might be able to help maintain long run economic profits for a little while anyway. So that's it for this segment. The next segment in this chapter, we go on and look at oligopoly, our last market structure, and we'll see you when we get there.